Hello guys, welcome back to the Successful Investor Club, the place where we invest and don't speculate. Today we're going to talk about the fundamentals of dividend investing and understand why it's important. Typically, large corporations whose businesses and profits are growing set aside a lot of cash reserves. Then some of these companies decide that part of these profits will be distributed directly to shareholders. This method of compensation is called a dividend payment. The money goes directly into your pocket and is completely passive, like falling from the sky. In this video, we'll learn how to calculate the two most important factors for evaluating whether a dividend company is worth it or not by analyzing the dividend growth and the payout ratio, which shows what percentage of the cash flow goes to pay the dividend. If you like these types of videos, subscribe to the channel and share the video with a friend. It will help the channel grow and this will motivate me to keep making these animations. Thank you. In order to understand exactly how important the dividends are, let's start the video with this graph, which shows that 75% of the returns of the S&P 500 index have come from dividends over the period from 1980 to 2019. The green line shows the investment of $100 in the S&P 500 index, with dividends received and reinvested. $100 became $5,200, while the blue line is the pure growth of the index without dividends and dividend reinvestments. From an investment of only $100, it became only $1,900. The difference is drastic and is most visible when viewed from a long-term perspective. Let me show you another chart from an additional point of view and you will draw your own conclusions. This is again a graph of the S&P 500 index. We will use it to explain what the effect of our returns might be if we have a lost decade. Blackstone is one of many funds along with people like Ray Dalio, Seth Klarman, Paul Tudor Jones who warn of a coming lost decade in which the stock market's growth is anemic and the market may not pass its previous highs. The last time this happened was not so long ago as you might think. In the early 2000s, the S&P 500 index was at 2,200 points. And the next time the market reached these numbers was all the way back in late 2014. People investing around the peak in the late 2000s had zero returns over a 14-year period. But the average dividend of the S&P 500 index over these 14 years was 2%. Despite the dividend, investing now in the S&P 500 index is only for people who understand the risks of the economic environment and are prepared to bear the future movements of the market. Novice investors with a burning desire to make quick money should keep one thing in mind, that everything is a part of cycles and the party is not forever. Now let's move on how to calculate the payout ratio. We find it by dividing the DPS or the dividend per share divided by the EPS or earnings per share. Earnings per share shows how profitable a company is per share of its stock. Dividends per share, on the other hand, measures the portion of a company's earnings that is paid out to shareholders. We find them in a simple Google search. But if we want to go to the trouble to calculate them, we divide the dividend by the number of shares to find the DPS, and for the EPS we divide the company's annual profits by the number of outstanding shares. Again, the payout ratio shows the percentage of cash flows that the company decides to allocate to its shareholders. To visualize things, take Apple as an example. They have a DPS of 82 cents and an EPS of $3.28. When we divide the DPS by the EPS, we find that Apple's payout ratio is about 25%, which is at the low end. While the largest grocery store in America, Walmart, has a DPS of $2.15 and an EPS of $5.19. which gives us a payout ratio of 41%. As an overall rule of thumb, we can remember that companies with higher potential growth have lower payout ratios because they are growing companies investing in new technology in order to grow their turnover, while older, more established, more mature companies with lower growth have higher payout ratios. This way, they compensate for reaching a plateau in their growth. It is important to mention that we want a gradual growth in the payout ratio. We do not want to see a sharp jump up because that would indicate that the company's earnings are falling, foreshadowing a dividend cut. And if we see a drop down in the payout ratio, that tells us that the company's management did a bad job as they haven't calculated well what percentage of the cash flows could be allocated to the dividend payments. Through this calculation, we see what the sustainability of the dividend is. Moving on with the dividend growth or the dividend growth rate. And again, mentioning we want to invest in companies that grow their cash position over time. Let's do an example with two companies, Company A and Company B. Company A grows its dividends by 10 cents each year. The first year it grows by 20%, the second by 17%, and the third year it grows its dividends by 14%. The dividend growth rate is the annualized amount over the period, or in other words, we add up the growth from the previous years and divided by the number of years. In the case of Company A, it is 51 divided by 3, giving us a 17% annualized dividend growth rate, while Company B has the same growth excluding its last year when the dividend got cut by 28%. This gives an annualized dividend growth of 0% for the period. The growth is extremely important because every year inflation rises and it devalues our money, and in order to neutralize this, the dividend must also grow. Thanks for watching till the end, and again, I would greatly appreciate if you subscribe in case you haven't already and like the video. That way you will help the channel grow and we all together will help more people to become financially literate. Thank you and see you soon.